Welcome to This Explainer. Today, we're going to explore a financial paradox that will completely change how you look at every single skyline, office building, and shopping center you drive past. We are unpacking the mind-bending reality of how real estate creates billionaires using assets that, legally speaking, appear to be losing money. We're going to break down exactly how this magic trick works, why powerful institutions desperately want property prices to keep rising, and what this all means for the future of our economy. Let's dive right in.
Okay, picture this. You've got a bustling apartment building. Every single month, it generates thousands in real, tangible cash from rent. The tenants are essentially paying the mortgage, the owner is building equity, and in the real world, the property is steadily going up in value. But fast forward to tax season. When the paperwork is actually filed, that very same lucrative building often reports $0 in taxable income to the government. On paper, it looks completely unprofitable. So how does any of that make sense? How can a building literally stuff an owner's pockets with cash in real life while legally reporting a loss?
Well, the secret sauce driving these massive paper losses is a little tax concept called depreciation. Basically, the government allows real estate owners to treat their buildings as assets that are slowly deteriorating over time. Even if the market value of that property is skyrocketing in the real world, the tax code just pretends the building is wearing out. That presumed imaginary decline is then deducted directly from the owner's taxable income. So the cash keeps flowing in, the building's value keeps going up, but the owner gets to legally shield a massive chunk of their wealth from the government. It's wild.
What you realize pretty quickly is that real estate operates on a completely different rulebook than what you and I experience in everyday life. Think about it. In normal life, it is incredibly hard to hide from taxes. Your salary is taxed directly before it even hits your bank account. And debt? Debt is that dark cloud that keeps you up at night. It's a heavy burden you just want to escape. But for real estate investors, the logic is completely flipped. The asset appreciates, the tax deductions kick in automatically, and debt actually stops behaving like a penalty. Instead, it transforms into pure financial fuel.
This brings us to a really foundational mindset shift for the wealthy. Experienced investors aren't actually out there chasing a higher salary. They chase assets that have built-in tax advantages automatically attached to them. In fact, billionaires and massive commercial property owners use advanced strategies, things like cost segregation, to accelerate those depreciation deductions even faster. They legally wipe out their taxable income for years at a time. To the average person, this feels completely backwards, right? Like, how can someone get wealthier every single year while reporting lower income? It's simply because they own assets that the tax code actively protects.
So that naturally leads us to the second layer of this wealth-building system, leverage. We really need to rethink debt for a second. For most of us, debt limits our freedom. It's the mortgage, the student loans, the credit card bills. But real estate turns debt completely on its head. It takes it from a heavy burden and turns it into a powerful tool for acquiring massive, generational wealth. Investors are obsessed with real estate because it's one of the only places where someone else, like a major bank, will just hand you enormous sums of money to buy an asset that is statistically highly likely to go up in value. Let's put some numbers to this to show you the sheer power of leverage. Say we have two investors. Person A takes $1 million in cash and buys stocks. The market goes up 10%, and hey, they make a very respectable $100,000 in profit. Great. But look at person B. They take that exact same $1 million, but use it as a 20% down payment on a $5 million piece of real estate. When their market goes up 10%, they control the appreciation on the entire $5 million asset. Their profit isn't $100,000, it's $500,000. The gain applies to the full value of the asset, even though 80% of it was bought with the bank's money. And banks happily do this because the physical building is safe, tangible collateral that produces real income.
Which brings us to one of the most powerful wealth engines ever created. I call it the infinite refinancing loop. Step 1. Your property appreciates. Now, normal logic says you've got to sell it to get your money, right? But selling triggers taxes, and we don't want that. So instead, step 2, you just go back to the bank and they issue a larger loan against that new higher value. Step 3, you pull that newly borrowed cash out to use however you want, completely tax-free. Why? Because the IRS doesn't tax borrowed money. And step 4, you still own the building. Your tenants continue to pay down that new debt, and you retain control of an appreciating asset while extracting millions in usable capital. It's a game changer.
When you lay it all out like this, step by step, you really have to stop and ask why. Why does the system treat real estate so differently from literally everything else? Why do buildings get special tax rules, huge bank loans, and endless loopholes? If you're sitting there thinking the game feels a bit rigged in favor of developers, well, you aren't entirely wrong. But the macroeconomic truth is actually much deeper and a lot more intentional than that.
The reality is, governments quietly want real estate investors to win. Our modern economies are built entirely on top of property. Think about it. Cities absolutely rely on rising property taxes to fund schools and pave roads. Banks hold massive amounts of mortgage debt on their balance sheets. Your own retirement pension fund is probably heavily invested in commercial real estate returns. This is exactly why the government actively needs people to build, buy, and hold. It's why they offer massive tax incentives, like the 1031 exchange, which lets investors delay paying taxes indefinitely as long as they keep rolling their money from one property right into another. The whole system is designed to keep you in the game.
And if you want to know what happens when this delicate balance breaks, well, just look at 2008. The financial crisis is the ultimate proof of our dependency on this asset class. Housing prices collapsed. That was the first domino. Because banks held so much mortgage debt, they instantly started failing. Construction just completely ground to a halt. People stopped spending, and the entire global economy began to violently shake. The damage spread absolutely everywhere, which proves just how deeply interconnected every single aspect of our financial system is with rising property values.
So, if the government protects it and the banks fund it, what are investors actually buying? Let's peel back the final layer of the onion here. The wealthiest investors aren't actually betting on the physical buildings at all. The bricks, the mortar, the roof, that's all just a shell. The core truth is that real estate investing is ultimately a bet on human movement. They are trying to predict before anyone else where millions of people are going to live, work, and spend their money in the future.
Think about the history of the world's most valuable land. Manhattan was once just farmland. Large chunks of Miami were quite literally swamps. Dubai was mostly empty desert. And Silicon Valley used to be a sprawling network of fruit orchards. The buildings didn't make these places valuable on their own. The people came first. Human activity concentrated in these locations, and then the land underneath them exploded in value. This is exactly why a company like McDonald's is basically a massive real estate portfolio disguised as a burger joint. Their long-term strength came from controlling the incredibly valuable land underneath their restaurants.
It's really one of the strangest and most fascinating dynamics in modern capitalism. A new highway gets built, maybe a massive train station opens up, or a major university expands into a new neighborhood. Suddenly, way more humans are competing for the exact same physical space. And the land? It just quietly absorbs the value created by all of that external activity. An investor's fortune can grow exponentially without them ever needing to hammer a single nail or actively improve the asset itself. The city grows, and the landowner reaps the reward.
All of this brings us to a somewhat uncomfortable truth. So many people are sitting on the sidelines, waiting for affordable homes, hoping for a massive permanent collapse in housing prices. But when you really understand how this system works, when you see the tax codes, the leverage, and the massive economic dependency, you have to ask yourself a hard question. Are you just waiting for a housing crash, or are you actually betting against the entire economy? Because a permanent collapse in property prices would instantly damage the banks, the local cities, and the retirement systems we all desperately rely on. The system leans heavily toward protecting property, and well, now you know exactly why. Thanks for joining me on this explainer.